Welcome to Fineotex Chemical Limited Q3FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Aarti Jhunjhunwala, Executive Director from Fineotex Chemical Limited. Thank you, and over to you, Ms. Aarti Jhunjhunwala.
Thanks. A very good afternoon, everyone, and I thank you for joining us today. Fineotex welcomes you to Q3FY23 earnings conference call. The financial statement and the presentation have already been posted on the stock exchange and website, and I hope you had the chance to review the same. Fineotex Chemical Limited is the leading manufacturer of specialty chemicals for numerous industries and also provides sustainable technical solutions and technical services, which is the key USP of our company. With over 470 plus product categories, we provide a comprehensive range of solutions for the entire textile value chain, from pre-treatment to finishing. In addition to textile chemicals, the company also produces drilling fluid chemicals and a variety of home care disinfectants, detergents, and sanitizers. With a focus on innovation and high-quality products, we are well positioned to meet the demands of our customers and grow in a dynamic and competitive world. Our strong results this quarter reflect the hard work and dedication of our team and the continued support of our customers. We are committed to sustainability and have implemented various initiatives to reduce the negative environmental impact. We believe that companies have a responsibility to operate in a way that benefits both their bottom line and the planet. We are also pleased to announce that we have invested in solar panels and installed a complete solar energy system into its operations at our Ambernath plant. This not only highlights our commitment to sustainability, but also demonstrates our forward-thinking approach towards utilizing renewable energy sources. Our recognitions with the Times Action's Women at Leadership Award highlights the importance of women leadership in the workplace and acknowledges the achievements of women who are making a significant impact on the society. We are delighted to announce that we have been honored with the highly regarded Business Excellence Award 2022 in the category of SME Chemicals and Pharmaceuticals by the prestigious Dun & Bradstreet Corporation. This recognition showcases Fineotex's commitment to excellence and its standing as a leading player in the chemical industry. This award is a testament to the hard work and dedication of our team and validation of the company's innovative products and customer-focused approach. Now, I would request Arindamji to walk us through our operational overview.
Thank you, Aarti, and a warm welcome to everyone. We are thrilled to share the progress and success we have achieved in the past year. Our high-quality, innovative chemical solution has paid off as we have seen significant growth in demand for our products. Our R&D efforts have resulted in the development of new and improved products that meet the evolving needs of our valued customers. We have also expanded our global reach. We have reached a new customer base, established new partnerships, channelized marketing, and increasing our presence in key textile and other markets. We have secured a major order from a leading FMCG company for our specialty performance chemicals. which is our team's glorious effort in last year. This is a testament to the quality of our products and the trust that our customers have placed in us. Expansion of our Amarnath plant has boosted our utilization capacity nearly around 83,000 tons to 104,000 tons annually. This accomplishment is a tribute to the efforts of our team and their ongoing support of our shareholders. I would like to thank our team for their hard work and dedication, and I'm confident that this is just the beginning of many more success to come in near future. We will continue to invest in our R&D and explore new growth opportunities while maintaining our focus on delivering exceptional products and services to our customers as a value-based industry, where we claim technology and service are the both platform to satisfy any point of customer. Now I request Sanjay ji to walk us through the quarterly performance of our company. Thank you. Thank you, everybody.
Thank you, Arindam ji. Good afternoon, everyone. Continuing from there onwards, our focus on financial discipline and operational efficiency has resulted in strong financial performance, demonstrated by growth in our revenues, EBITDA margins, and profit after tax. We are excited to announce another successful quarter as a result of our steadfast commitment to consistent performance. Let me bring you on the highlights of the 9 months and the quarter 3. During 9 months, financial year 2023, our operational revenue rose to 379 crores, representing a year-on-year increase of 54% approximately. Our EBITDA has reached 80 crores approximately, with a YOY increase of 61% and EBITDA margins of 21.1%. We have also recorded a profit after tax of 63.6 crores, with a YOY increase of 59.3% and a PAT margin of 16.8%. Our annualized ROCE and ROE are 29.1 and 35% respectively. In quarter 3, financial year 23, our operational revenue improved to 1,092 million from 1,051 million. The operational EBITDA has grown by 14% from 251 million to 286 million, with a margin of 26.1%. PAT grew by 17.8% from 191 million to 225 million, and with a margin of 20.6%. The volume has doubled, and the increase is 100.12% YOY basis, which demonstrates the strong performance and success of the company once again. We are thrilled to announce an improvement in our credit rating by CRISIL. Our long-term debt has been upgraded to CRISIL A stable from the earlier rating of A minus, and our short-term debt has been upgraded to CRISIL A1 from earlier CRISIL A2 plus. This upgrade reflects the positive financial growth and the stability we have achieved. In addition to the accomplishment already mentioned, I would like to bring to your attention some more significant achievements. Your company has been certified as Great Place to Work in the last 9 months. It has been also included in the Nifty Microcap Index and Morgan Stanley CIE in Small Cap Index. The new rating from ICRA and the upgrade of CRISIL, inducted as an A group company in the category of listed companies. Our best-selling antimicrobial treatment, HealthGuard AMIC, has received the US EPA approval. With this, I will open the call for interactive question and answer session. Over to you, please.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may press star 1 to ask a question. We have the first question from the line of Kush Tandon from Ananta Capital. Please go ahead.
Good afternoon, sir.
Good afternoon.
Many congratulations on a good and consistent performance over the last 6-7 quarters. I just had a few questions, sir. My observation is that as we are moving more and more towards FMCG business, it looks like it's very ROCE accretive. And should that be the main reason why our working capital and cash flows and ROCE has improved so much in the last few quarters?
Thank you, Mr. Kush Tandon, about this. Yes, you are rightly said. As we have proceeded towards more FMCG cleaning and hygiene businesses, which has a better cash flow and a better working capital requirement compared to the traditional textile chemicals. Yes, there has been an improvement on it. Right now, as such, we are almost, we can say, 40% of our volume is contributing to the cleaning and hygiene segment right now.
Okay, great. So, sir, also just one small question. What will be our operating cash flow this quarter? Is it how much of EBITDA would have converted to operating cash flow?
See, as such, our EBITDA has been almost 80 crores in the current 9 months, and out of which around 60, so let's say 87% is the operating cash flow, which is 87% of the EBITDA is the operating cash flow, almost 87%.
Okay, understood. So finally, we understand that you had received a large order from an FMCG major for around 150 crores in the last quarter that you had put an exchange filing also.
Right.
And I'm assuming that you have started supplying somewhere in Q3. So just wanted to know that probably the full impact of this order may come in Q4 and subsequent quarters. Is that a fair statement to make?
It is point correct. As such, we just started off on that order. There was a very little time, and it takes time for the FMCG companies to readjust their supply chain and other inventories. So yes, we just had a small requirement in the month of December and little bit in November. That was just, you can say, the beginning of the consignments. I think less than around 10 crores business was there on the new product line. And this has been picked up now from 15th January also. And I think you should be seeing that impact happening from Q4 for sure. And more importantly, from the next year onwards, we are also looking at some more, the upgrade in the volumes also going forward. So this is, yes, you can see the impact from the Q4 businesses.
Okay. Great going, sir. Many congratulations once again, and all the best to you, sir.
Thank you, Mr. Thank you very much.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may please press star and 1 now. The next question is from the line of Ashish Rathi from Lucky Investments. Please go ahead.
Yeah, hi. Thanks for the opportunity. We just wanted to check what is the scope of diversification in terms of the products in the home and hygiene segment which we have, because we seem to have some bit of client concentration here.
Okay.
We understand what is the progress in some of other potential clients.
See, as such, we have always been a very high specialty performance chemical producer for technical textiles, and also providing a lot of technical solutions, sustainable solutions and technical services, which has been our core business as such. Along with this, we have been working towards the other avenues where the similar kind of fungible production requirements and the similar kind of product chemistries have been using. And that's the way 3 years back we entered more into the cleaning and hygiene sectors, oil and gas, where the similar kind of product lines were also going for different applications. Let's say that is also part of textile chemistry also, because textile also reads cleaning and hygiene and cleaning stuffs and surfactants. Same things has been happening with the new cleaning hygiene FMCG businesses. So as such diversifications, I would rather say we are moving towards other businesses and growing the textiles also, and also which is our core business. At the same time, we have diversified into the cleaning hygiene and other businesses, which are in fact more promising from the point of view. These are COVID-proof businesses as such. Also, these businesses generally do not have a wavy kind of a demand. Textiles may on and off, you must be also watching up that sometimes due to the cotton prices and cotton seed prices, sometimes there is a fluctuation in the in the cotton demand and the production, and sometimes 1 or 2 quarters are lower than the next quarter brings it back to the normalcy. That happens with most of the biggest textile companies also as such. So basically getting into diversification into such FMCG, cleaning and hygiene business is the best thing what the company could achieve. And this should be the right way of a chemical company also to, balance it out. Right now, we have already balanced out almost 40% of our businesses FMCG right now. And in FMCG also, I would like to mention that we have been here for last 3 years. Of course, we have our plant audits and we have FDA certification. So we have many products for cleaning, for, most of the home care and other personal items. However, I would also like to mention we are already diversified. We have Patanjali with us. I don't want to name too many of the customers we have, but I would like to mention that we are quite diversified and there are very close, interest which has been seen from very big international, multinational giants. Those who have shown a lot of interest and there is a lot of product evaluation going on. So once we got into this, I am very sure our team will be able to further diversify and make sure that we have more number of customers for these. Right now, we are already having substantial number of customers. We are picking up the volumes from each of them. This is for the cleaning and hygiene. Also for textiles, I would like to mention the top 10 customers contribute only 27% of our business and the top 10 products contribute only 18% of our business. So as such, I would like to mention with the 470 product lines which we have, and in that we are doing almost all sorts of chemistries, phosphonation, sulfonation, polymerization, esterification. I think we are rightly quite diversified from the customer point of view and from the product. We are quite de-risked from that point of view. This is what I would like to mention.
Sure. I appreciate your diversification into the home and hygiene segment per se, and textile being a diversified space. The concern or the observation was more in regards to the home and hygiene segment, where we have large concentration for one particular or two particular products with a single client or maybe two at best. So this is where we were, just looking forward to some more diversification, Sanjay. But your explanation is fine. On the second point, in the EBITDA margins, if I wanted to understand what is the kind of sustainable and steady range that we as investors should look forward to, say, for the next couple of years?
Yeah, Ashishji, I would like to also mention in a different way for the last 50 quarters of being listed. In any of the quarter, you will always see that our EBITDA has always been minimum 16-17% and up to 24%. That has been on the period of 12 years being listed. And in the last 3-4 years, we all are aware about what kind of, turmoils or certain situations, right from COVID, from supply constraints, containers not getting available, freight charges, many things the entire world has faced through, even the geopolitical situations, and also the slowdown things and recessions. In spite of all those things, we have been able to, grow our EBITDA, or I can also mention to match the EBITDA of even the last year. So even the last year, our quarter 3 EBITDA was around 24-25% broadly. Even today, we are at 25-26%. Also keeping in mind that now our new plant has already been commissioned. Now, when the plant is getting commissioned, there is for sure a lot of pre-operative expenses, revenue expenses, which will be there before the plant begins, before you start even a single kilo of productions. Now, those things are already factored in. At the same time, we have brought great operational efficiencies, the automatizations, the kind of infrastructure we have for machineries is something which is quite remarkable. And this has helped us to reduce our overheads of manpower, labor, and we have gone for more automatizations. Also, the reactor sizes are so big enough that the overall overhead cost per kilo has gone down. So we have worked on those kinds of operational efficiencies, which were always anticipating. In most of my con calls, you might have, if you would have been there, you would have, heard the same thing. Like we were always quite confident about having a better EBITDA margins going forward. And also, what has also been happening now in the last few months, there has been certain reduction in the freight cost. There has been certain reduction in the basic price of the chemicals. Now, these things also helps us to have a better EBITDA. See, I like to mention to all of the participants today, along taking up this question as well, that our company is a very high-end tech specialty chemical producer. we are not those kinds of companies where you will sign our EBITDA sometimes 5%, sometimes 35%. This will never happen with Fineotex. And this is not our main business. When we sell our product, we sell as a solution. We are not like a COA-driven business where your purity and solid contents is there and there are other Me Too makers or something like this. We are in a business where we are like a homeopathy solution provider. We provide the solutions. The cost is not material to the customers because, like I always say, the 4 processes of textile together require 25 different functional chemicals, and all put together contribute only 3% cost to the user. So every chemical is costing 0.15%, which is insignificant. At the same time, the risk of changing a chemical is very high. So there is a big risk entry-exit barrier for the businesses. When the raw material prices goes down, like what has also happened now, our EBITDA margins does go up because of that as well. And then that also helps us to, get more motivated to have more kind of, marketing promotional expenses and getting into more requirements of the customers. So this is the way to look at us. We are very confident on the EBITDA margins always, which has been proven for the last 50 quarters. I think going forward also you can expect similar range of EBITDA margins what you have seen in the last few quarters.
Sure. And you initially mentioned about the capex. You said that you might be looking at adding more volumes the next year or so. Could you indicate the kind of numbers we have in terms of volume capacity right now? What sales it can sail us through, and when will we need the new lines?
See, Ashish, what has happened is we have just on 14 November started the 21,000 production capacity. Okay, earlier it was 84, now it's 83, now it's 104. So that is almost 25% on it. And in the last quarter, we have not yet performed the way it will happen for the new businesses which we have got, because that was just new in new ones only. So that has not been seen yet, which is happening now in quarter 4. Right now, if I say while we speak today and the way it is going on, I'll try to be quite, I'll try to give too much of forward-looking statements on here. But I think we have the first aim here would be to reach the optimum utilization of 80-85% right now, which we are gearing up for. And I think by the next month, by mid of Feb, we will be able to plan the next round of capacity increase, which will also be done in the same plant where we have a lot of spaces. At the same time, this additional capex timeline will not take us too much of a time because already most of the infrastructure is well laid off. The administrative, the environment, permissions, planning, structuring, the machineries, more or less everything, the building fundas are already well set. So I think this is the plan we have right now. By next month, we'll be able to plan the next round of capex.
Okay. Lastly, Sanjay, congratulations on the steady progress and diversification of business and working capital betterment. I acknowledge as investors that we are heading in the right direction. Hi, IOC, and good growth. I wish you all the best and the team as well.
Thank you so much, Ashish.
Thank you. Participants who want to ask a question may please press star and 1 now. The next question is from the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Hello. Yeah, thank you for taking my question, sir. Just one question on this. As you mentioned that 40% of the volume is towards the FMCG side. So does that same applies to the value front also, or is there any difference in value and volume term?
So as such, generally the price per kilo, the realization in cleaning and hygiene per kilo is quite lower compared to textiles. That is one. However, the volumes will always be good enough, and so it will lead to the overall turnover would be almost again contributing to 40-50% going forward. So this is the position. If you want exact numbers, broadly, average realization per kilo in textiles generally is like 130-40 rupees. That's the normal levels. But in the detergents, it's almost like 60 to 65 rupees broadly per kilo. So it's almost, you can say, little like almost 40% of it.
Okay. Okay.
Yeah.
When we take up our combined capacity after addition of this 24,000, so how we should see, is there any bifurcation we can do for textile and FMCG, or it is the same, that these same capacity will be going to, same product would be going to textile or FMCG?
See, actually, I'll tell you, our capacities are fungible in the same kind of machinery setup. The same kind, the products for textiles can be produced for oil, and also for the cleaning and hygiene, and various things can be produced. So, actually, from the investment point of view, it is a fungible asset and which can always be switched over. So that is one part of it. Going forward, our main core business has always been solution provider for the textile businesses. That is going well. It is increasing. It is definitely going to increase further on. Yes, textiles sometimes have less demands in a quarter, then again the next quarters cover it up, things like this. But going forward, the most difficult part for any specialty chemical company would be to enter the FMCG. Now, FMCG is one area which is really, really a challenge, and it's one of the best areas to be, because you are sure of sustainable businesses, generally speaking. Because the demands in FMCGs are like, it doesn't fluctuate a lot as much as it fluctuates in the textile businesses. So I think for any company, and for us also, we are very much delighted the way we have progressed in last 3 years. It took a lot of time. It takes a very long time in the FMCG.
Ladies and gentlemen, the line of Mr. Sanjay Tibrewala has been disconnected. Kindly stay connected while we try to reconnect them. Ladies and gentlemen, thank you for your patience. The line of Mr. Sanjay Tibrewala has been connected. Over to you, sir.
Yeah, sorry, Rohitji and all. Let me continue with the answer to it. So, yes, any chemical company in our range, FMCG is one of the most difficult sector to enter. It takes a long time even to get a sampling request and things like that. So we are very much excited, and we are very much that in the last 3 years of efforts which we have been doing from before the COVID actually has finally shaped up that big brands like Patanjali labels and other ones have started using our products in their FMCG products. So this is something which we are very happy about. And so this is to reply to your query.
Okay, got it. And when we say the realizations are almost double in textile, does that difference, is there any in the margin front, or it will remain more or less similar for the combined business or for both the businesses?
In textiles, what also happens is there is a lot of promotional expenses, technical services which we are providing, and things like that. So there is a good gross margins in textiles as such. However, looking at the blended EBITDA, if you talk about the EBITDA margins, more or less it is similar, because in detergents, then your overheads are not too high from the point of view of giving technical services comparatively to the textile businesses. So as such, we look at our business from the EBITDA point of view. We only work with product lines which have a higher EBITDA, and I think that's the main difference between a commodity chemical company and a specialty chemical company, the EBITDA margin itself. As such, this is the way we have been going forward, and we believe we are in the right directions, and the kind of projection which we are getting from most of the FMCG players, and we are in talks with many of them right now, that they also would like to improve their product with certain additives and things like that. So we are very excited with the journey right now for the FMCG as well. Yeah.
Okay. And any outlook you can provide for the textile side, as currently, obviously, for last few quarters we are seeing the slowdown. So any recovery kind of thing visible from your side, or it's still a long way?
Yeah, I understand your point of view. I'll say two things. One is the external things and one is our businesses. So let me put it like that. We never lost any product. We never lost any customer. I'm talking about textiles. And so I would like to mention, yes, the demand per product per customer might have reduced or got postponed also due to some demands in the foreign lands which has reduced broadly. But also I would like to mention the same kind of situation happened in 2020 in the first COVID one. And that also was a very big slag for the textile businesses. And then we all have witnessed the kind of jump the home textile market has seen, whether it is Indocounts or Welspens or Himatsinka and GHCL and all these companies. So broadly, I would like to mention to all of our investors that textile will not longer be an industry which you can view quarter by quarter. This is something to be viewed on an average of 2 years and understand where it was, where it is now. I think that would be the right indicator. The reason being, number one, from the time the cotton is grown at the farms and up to the time the fabric is being sold in Walmarts or whichever mall where it's a great long gestation period of 6 months. So what happens is whenever the cotton prices goes up, most of the biggest buyers of the world, they stop ordering more because there is enough of fabrics and garments in the pipeline, which will be enough for them to survive for one season or something, more or less. So that is the time when most of the investors of the companies, like the textile companies who have invested in machines, and we also been servicing to them, they have little less of volumes. But as such, if we talk, it is just a seasonal variations. It is just a wave of the business. I don't see this can be prolonged. And I see that already from 14, 15 Jan, things are getting much, much better than it was. I'm talking of textiles now. And also what we have experienced is that most of the pricing of cotton has corrected, and also the pricing of textile chemicals, raw materials have corrected. Now what happens is with that, most of the buyers, they do not have a high inventory level. They all go for lower inventory level because they understand that, the prices might go down. And then it is unlike the last year which we had seen, last financial year, when the prices was going up because of Chinese factors and the freight costs and other things. So this is something which is being happening now. Going forward, I think this is the right way to view the textile businesses, is not quarter on quarter basis. And the demands are coming back, which we have experienced in the last 15 days. So I think while we complete this quarter, I think it should be much, much better than what we have seen in the last 6 months. This is our view about it.
Okay. Thank you, sir. I'll come back in queue. Thank you.
Yes.
Best of luck.
Thank you, Ritu.
Yeah. Thank you. The next question is from the line of Nikhil Rumta from Nippon India Mutual Fund. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. Sir, couple of questions from my side. First is on our margins. I mean, this quarter have shown a very strong margin of 26 odd percent. What would be sustainable margin for us? Do you think it would be in the range of 18 to 20 odd percent itself, or do you think it might go up as well?
Thank you, Nikhilji. I got similar kind of a question just a while back as such. And yes, I can mention to you that our 9 months average EBITDA margin is 21.6%. I would rate that as our minimum level where we are. That's I'm talking from the minimum level point of view. However, the way the business is going down, and most importantly, the kind of new operational efficiency we have got, the kind of optimization which we have done in our expenses and revenue cost and things like that, I am quite confident that where we have achieved this quarter and somewhere between the average mean of the 9 months, which is 21.6%. So it would be that would be the place it would be. It will not go to the level where it was, at least for the next few quarters, looking at the kind of businesses and orders we have in hand also.
Right. So, sir, over last a couple of years, our share of cleaning and hygiene chemicals in the overall business is increasing. So is our EBITDA margin, which we are seeing. So, can you just give specifically in the three segments what type of EBITDA margin you are getting, basically in the cleaning and hygiene segment, in drilling specialty and other specialty, which is textile?
See, as you have rightly mentioned, in the last 5 quarters, our business of cleaning, hygiene, FMCG has gone almost, we can say almost 20 times from where it was as such. And talking about the EBITDA margins, I would like to mention there's a deviation in the gross margins between both the product lines as such. Textile businesses will have a higher gross margins, but there will be a lot of technical services, plant audit certifications, product certifications, German audits, and a lot of other expenses which will be there in the revenue expenses as such, which will affect the EBITDA. The blended EBITDA or maybe the individual EBITDA for all the businesses which we have experienced is almost the similar ones where it is today. And yes, sometimes there can be some fluctuations, but that fluctuation cannot be more than 100 basis point plus or minus. So I would like to mention you can consider the total EBITDA of our company, which is the EBITDA for each and every segment line as such. Yes, there is a great benefit in the FMCG business is one, the businesses are like COVID-free businesses, the volumes is good enough. That will give you more churning around. It will also help your working capital. As you might have noticed, our working capital from 140 days is today at 94 days. It is also definitely because of our FMCG business, which you will see more betterment in this quarter with the new orders, and again the payment terms and the supply, in the working capital will be much better. So going forward, if you talk about EBITDA percentage, the answer is yes, the blended ones will be in the similar line, and that would So that's the point.
Okay. So individual segment specific we should not look at, but you will continue to post around 20-21% of EBITDA margin.
Also keep in mind, these are like fungible product lines. There are certain products of the FMCG which is going to the textiles also. Because see, let's say textiles. So FMCG is also into cleaning. When we say FMCG, it is, let's say, detergent soaps, detergents liquid, detergents powder. Again, it is used for cleaning the textiles. Maybe this is done only for the hand washes or for the washing machines. But at the same time, you're treating it on the textiles. Now, our main technical core business for the last so many decades has been servicing the technical textiles and technical solutions which we have been giving. So these are like the same kind of product lines. I mean, I'm not saying 100% same, but you can say 90-95% there has been a correlation in the raw materials and the pricing. So if we get a benefit of pricing powers and the raw material volumes which we get from the FMCG, that same benefit will also fall for the textiles. Because if you're procuring a raw material which is going for, let's say, cleaning and hygiene, that same product will also have its way in textiles where our EBITDAs will get much better also. So both the businesses are supporting each other as such.
Right.
So you can look at it as a totality only. And it's not a new investment from a different investment. In this investment, what we have done, we cannot produce textile, और जहाँ पे textile करते हैं वहाँ पे FMCG cleaning नहीं होगा. ऐसा नहीं है. वो same चीज में it is more like the layman language is more like a kitchen industry where in the same pan you can cook the different kind of vegetables or things like that. So that's the analogy I would like to give to the participants.
Got it. So last question from my side.
That also translates that why is the asset turnover ratio still strong enough, and it will get more stronger the way we will proceed ahead, because it's in the same capacities we are able to produce all the kinds of product requirements.
Got it. So last question from my side. We had increased our capacity by 21,000 MTPA during the quarter, and now it's 104,000. So how much land or space do we still have in Ambernath so that we can, to what extent we can increase our capacities before going for another greenfield expansion?
See, there is a lot of planning and space which we have in Ambernath. When we entered in this place, we always had in view the phase-wise expansion which should be facilitated. Because right now, as we all know, the Indian and any country has a lot of restrictions on chemical plants and new permissions and EC permissions, things like that. So we always had this thing in mind, and then from that point of view, we have quite enough space. We can always have, and already the new buildings are also erected now. The third building also has been erected, and there is quite enough space for the expansion. Right now, where we are today as like 104,000 tons, I think another 35-40% easily we can expand in the same line, and that would not take a lot of investments also, nor it would take a lot of time comparatively.
Got it. Perfect. Perfect, sir. That's all from my side. Thank you so much and all the best for the mission.
Thank you so much.
Thank you. The next question is from the line of Vinayak Mohta from Stallion Asset. Please go ahead.
Hello. Yeah, am I audible?
Yes, please proceed.
Yeah. So I just had a question with regards to the growth expectations. Like given that you've already mentioned that you have expanded the capacities by 20-25% and you'll be expanding it further after you decided in in February or March. So can we expect 25-30% kind of growth to continue for the next 2 to 3 years in that case?
See, I will also like to mention we have increased our capacity from 43,000 tons to 104,000 tons in the last 16 months. In fact, not even 16 months, it is 14 months precisely. The first expansion was in November 2021, and from that point of view, we have expanded on the next league on last November, that was 14 November. So there has been almost an expansion of almost 2.5 times or 2.3 times from the earlier places. And not only expansion, it has been in quarter by quarter, our utilization has also gone to remarkable extent that we had to increase the expansion step by step. Now going forward, the last expansion which we have done of 21,000 tons, we are quite hopeful that by this quarter we will be also utilizing it in a good way. The next coming 2 to 3 years, like you mentioned, 25 to 30%, I'm quite confident about it. Also, from the point of view, even if you see us in the last 12 years of being listed, our average growth is 24% on a CAGR of 12 years. I think it's something which we have been doing more or less every time. And not only from the historic point of view, but from the excitement of having the right kind of business line today. The efforts which we have done from 2019, which has started paying in 2022, and the major benefits which we will be seeing from as we speak from this quarter onwards to the next 2 years, we are definitely sure that we have no way looking back below what you mentioned about the growth rate. But this is something which is definitely, we will be achieving as such. But we would like to do something what we have done in the last 2 years. We would like to go to a different level of growth percentages organically. And I think if the way the things are working well, and again, if I say that the textile is also going to come back and it's almost looking that it is going to come back very soon, I think it will not be wrong to say that we will definitely, touch this kind of a growth rate again.
Understood. And so your volume growth has been 100% around, but your revenue growth has not been on a similar scale. So is that a factor of product mix because your realizations differ, or is that a factor of the prices of those chemicals going down?
See, there is many things. As we say that we have like 450 plus product lines, and the FMCG cleaning hygiene product lines are low price realization. Of course, this does matter in having the similar kind of growth rate. That does definitely affect. There is no doubt about it. But also, if you consider in last year when we closed at 220 crores, then the next one was 379. This year we have already done 380 crores with a great EBITDA margins in the 9 months itself. And there is a big quarter left out, which is the most important quarter for the entire year. So I would not say that the sales has not gone up in the similar directions. Yes, but that is not the way only to look at us. I think you should look Fineotex in a way as a very high-end specialty chemical company, which is translated by 3 things. I believe is the EBITDA margins, which is consistently growing, consistently there. Asset turnover ratios are quite good enough, which also demonstrates our products specialty and the performance, the focus which we have. And the third thing which we are quite happy about is our cash flows, which is our cash flow is almost 87% to the EBITDA this thing. So operating this thing OFC. So that is the kind of things we have having our friends along with us. That's about it.
So one last question. So given the sectors you're present in, these are sectors, where the demand is sustainable and there's hardly any time where you will not use these products. So from a demand perspective, market opportunity side, margins, you've been consistent. So, and you are coming up with additional capacities which will allow you to go to newer players and penetrate into existing players as well. There ideally would be some of the risks that you would see, that could come and hamper the business apart from the slowdown that textiles as a sector would see, because FMCG is relatively consistent. So what are some of the risks that you think that could impact the business or could, hamper the growth at the very least?
In Mohtaji, actually, I don't know what can I answer, but I can say the chemical companies in the last 2 years have seen, or maybe entire world has seen almost all the ups and downs in the last 2 years. There is nothing new which was anticipated or which has not yet come. I think everything has come to the world, including geopolitical situations, the recent recessions, again something cropping up in China last month for the COVID. The demand is one part of it, supply, freight costs, containers not getting available at any price. So all the things are happened already, and I think we have relatively done one of the best what we could do and have reached wherever we are today. So I am quite confident, even if there is something more to come to the world, which is not yet anticipated, I think Fineotex will be able to sail through very well. And so this is all I can say. I don't see anything undiscovered yet, which could happen to the business of chemicals or textiles or maybe to the world in general.
Understood. So just one clarification on the working capital days. You said that you will be able to get that down to what level approximately?
No, as such, our working capital for the last 2 quarters has come back to 94 levels from the original 140 levels. So this is also due to the mix of the product lines where we are, and also in textiles we have got more, more prudent about the cash payments and things like that, where we have also started offering some, the dealers some sort of, cash discount policies and things like that, which has also helped us. But yeah, this is the output of these things. So yeah, right now we are on 94 days broadly as we speak. I think in the future it will be much lower than 90.
Understood. And any potential inorganic acquisitions that you are looking at or anything else of that sort?
Okay. So here opens a different angle. As such, let me mention that, after our IPO 12 years back, we did invest in Fineotex, which is a European founded company producing specialty chemicals in Malaysia. We acquired 72% of it from the IPO proceeds in the 3 months of listing. And when we did that was our first inorganic made in international acquisition. And the international acquisitions as such are more difficult than the domestic ones. I think it has sailed very well. We are very much happy with the performance of the team. It gives us good energy and scope of getting into more such opportunities. But as such, we are very disciplined in our cash deployment. We have a great sense of the synergy, and we will not do anything, or we will not buy any kind of a company which is not matching to our main synergy, which is either in the chemistry, product chemistries, or from the market point of view. Something which goes in our markets, let's say the cleaning, hygiene, textiles, or oil and gas, that is one. Or maybe the same chemistry which is going for different businesses. Those can be our targets. There has to be a great synergy. And of course, from the value point of view, we are quite, conservative in placing a value of it. So we keep looking at it. There are a lot of proposals which do come. At the same time, there is a lot of cash flow which is being generated by the company internal accruals. I think that will also be utilized for such kinds of activity whenever it happens. So right now, there is nothing immediate to be shaped up.
Understood. Fair enough, sir. Thank you so much and all the best for the future.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all participants, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Anupam Agarwal from Lucky Investment Managers. Please go ahead.
Yeah, hi team. Good afternoon. Thank you for the opportunity. Sanjay sir, my question to you was, you mentioned that FMCG business was 40% of volume this quarter. So if I do some sort of calculation, it's a sequential decline over last quarter. If you can explain the reason behind that, please.
I would like to mention what is also happening is in the last quarter, there was some decline in the FMCG businesses also. Also, if you can also go through it, there has been a decline in the prices of certain cleaning chemicals. Let's say caustic has gone down, certain things. So most of the FMCG companies broadly have also reduced their inventory levels and purchase levels and most of the things were also postponed for January businesses as such. Because in a falling situation where the raw materials are pricing getting downer, most of the companies will always look at having lower inventory levels. So this is something which has happened. The demand, I don't see there was a great change in the demand as much as we see in the textiles for sure. And these things have again picked up. So it is more of you can say certain orders of December which have been postponed to January for certain requirements and things like that. So it is not it would not, that would be covered up in the next quarter, something like that.
Understood. So Q4 should be on a volume quarterly basis in FMCG business cross the Q1, Q2 levels or?
Oh yes, for sure. No, for sure it will do it because there is a lot of more businesses which we have tapped. But that has also not reached the fullest extent because of the year-ending things and the calendar year-ending things. And also it takes time for certain FMCG companies to relook at their SAP and inventory levels and supply chain things like that. So FMCG is one of the most difficult areas to work with, but this is once you enter, this is the best area. So I would rather say this is it takes time, and now that we have reached a level and now things are working towards us. So we are very much optimistic that we'll outbeat the earlier quarters for sure. There's no doubt about it.
Great. Second question to you was the 150 crore new order. In terms of per kilo realization, is it similar to the first order that we had of 200 crores?
No. Per kilo realization, this is around 49.50 rupees per kilo broadly, the new one. That is
okay.
But again, as we speak, we have not yet supplied much as we have answered this in some of the initial questions of this conference. As we have supplied, I think around 2,000 tons only. 2,000 tons broadly, so that would be around 10 crores only we have supplied in the last December month, and a lot of things have been postponed for the January months and things like that. That 150 will also be increased actually, so it is on the conservative level. It is 150 as such. That is
all right.
Another remark. Yeah.
All right. And at 50 rupees, we are able to make a similar margins what we make at the first product of 65, 60, 70 rupees.
We are able to make a similar EBITDA margins on that because as we said that, the overheads in this business is comparatively much, much lower than our main core business of textile specialty where you have a lot of product audits, exhibitions, manpower, technical doctors for servicing, and etc. So yes, if you talk about EBITDA numbers, yes, it will be the same range.
Understood. Also, last question, now that we have the entire 104,000 tons capacity coming through for the entire year available to us, what kind of utilization should we expect for FY24 on an overall blended level across two businesses?
See, let's say in a way that always whenever we have been expanding, we always touched almost 70% of the utilization. I'm talking about the earlier quarters. With this new plant, the new kind of machinery, the new movements, the optimum utilization capacity will go up. And this, I believe, would be 85% broadly, more or less. So let's say when we are on a level of 80,000 tons or 85,000 tons, considering 1 lakh round ballpark number, I think from that point onwards, we will be requiring more capacity addition. Now, when do we reach this capacity? I don't think it is too far for us to reach here at the moment. And once we are just exactly sure about it, which will be sure in the coming 1 or 2 weeks or something like this in the Feb month, we'll be planning for the next expansion activity. And once we plan that, I think it's another 6 months for us to, let's say by Diwali maximum,